It's Wall Street's dirty little secret, hidden cost and inefficiencies of mutual funds. Get ready to learn something maybe you've never heard. The author of Mutual Funds Exposed, Dr. Kenneth Kim, is our special guest next on Your Money Matters.
The topics discussed on this show are developed from sources believed to be reliable and is provided for informational purposes only. Chrissy Smith and Matt Kennedy are investment advisor representatives with Equus Capital Management, Inc., a registered investment advisor. Neither Equus nor the Presley Group render or offer to render investment advice through this program. This is not an offer to sell securities or provide investment advice, which may be done only after a client suitability review is conducted and appropriate disclosures made. Advisory services are offered through Equus Capital Management, Inc. and may only be offered in states where registered. Equus does not provide insurance services. Neither the Presley Group nor Equus provide tax or legal advice. The Presley Group, LLC and Equus Capital Management, Inc. are not affiliated.
Good morning, I'm Matt Kennedy. Christy Smith will be along shortly, and we have a real special guest today, Dr. Kenneth Kim. He is the chief strategist for Equus Capital out in San Francisco, California, and the co-author of the brand new book, Mutual Funds Exposed. Everything I thought I knew about mutual funds has been, exposed by Dr. Kim. He's been a professor of finance for 20 years. He's taught at 16 different universities, including the State University of New York at Buffalo. He's been at Georgetown, University of Michigan. Dr. Kim has spent his entire academic career exposing inefficiencies in financial markets and in the financial industry through all of his writings and his research, including the Journal of Business, Journal of Financial Markets, Journal of Financial Intermediation. His desire and dedication to protect and help investors led to an appointment as senior financial economist for the U.S. Securities and Exchange Commission in Washington, D.C. in the late 1990s. This guy has been quoted and researched and requoted in the Wall Street Journal, Business Week, Newsweek, the New York Times, Washington Post, Boston Globe, Fox News, CNBC, CBS Radio, and again, Dr. Kim is now the chief financial strategist at Equus Capital Management and the author of Mutual Funds Exposed. Dr. Kim, thank you for the time. Thank you for joining us. We value your expertise. In the book, Mutual Funds Exposed, what are you exposing? What led to this book with you and Dr. Nelson?
Well, first of all, thanks for having me on the show. So the reason why we wrote this book at this time is because technology has finally improved the way that people can invest. And so with this improvement, we thought it was a good time to remind people of, the problems with mutual funds. The problems with mutual funds have always been there. They've been known for a long time, but there wasn't really much that we could do about it because there weren't better ways to invest. But now there is with the 21st century technology that's available. And I can talk about that, later in the show. Mm-hmm. But we just thought this would be a good time to remind people the problems of mutual funds so that they can have access to better investments today that is available today.
But I guess what's made mutual funds so popular is that's what people have in their 401k. So it's sort of the investment vehicle of default, right?
That's correct. I mean, mutual funds, at one time was a great innovation because it allowed investors and savers. It allowed us to have access to a professionally managed, diversified portfolio. So at one time that was great for investors, but the structure of mutual funds is a little bit odd. It's odd in that when investors buy a mutual fund, they don't directly own the securities in the fund. Instead, the mutual fund owns them on our behalf. And that means that we are commingled investors, and that creates a lot of inefficiencies, inefficiencies that can lead to hidden costs and tax inefficiencies. It could be a drag on performance, because the best way to invest, of course, would be to just be able to directly invest and hold securities individually on our own.
Our guest is Dr. Kenneth Kim, Chief Financial Strategist with Equus and co-author of the book, Mutual Funds Exposed. Okay, let's start by talking about one of the first things you talk about in the book, and that is tax inefficiencies. And I love how you do it in the book. You have an example of the money the Monkey Mutual Fund and how it owns banana computer stock. Use that example, if you don't mind, to help explain tax inefficiencies of mutual funds.
Oh, sure. Yeah, I'd be happy to. So this tax inefficiency is also known as the embedded capital gains problem of mutual funds. And so let's say you and I buy a mutual fund today, and it has a stock in it that's priced at, let's say, $80 a share. Next week, if that stock price goes to $70 per share, obviously you and I have lost money in our investment. But now let's say that mutual fund decides that they're going to sell that stock. You and I are probably thinking we're going to experience some tax loss benefits, but actually it may be the case that when this mutual fund purchased the stock, it purchases it at, let's say, $35 a share. So the mutual fund has experienced a 100% capital gain because they bought at 35, they're going to sell at 70. This capital gain, they're going to, of course, have to pay a capital gains tax on it. Mm-hmm. Now, because you and I own this mutual fund, that means we are also partially responsible for this capital gain, believe it or not, even though you and I have personally suffered a loss on this stock. And so this is part of the inefficiency of mutual funds because we're not directly owning the stock. When you and I bought this fund, the cost basis that matters is not when you and I purchased the fund; it's when the mutual fund purchased the securities.
And then shortly after that explanation in the book, you go into some detail on how commissions can become such a great drag on mutual fund returns as well.
Correct, and this is part of the hidden cost of mutual funds. You know, the hidden cost of mutual funds, and I call them hidden costs because they're not disclosed costs, and the reason why they're not disclosed is because these hidden costs are hard to estimate. The hidden cost of mutual funds can actually be larger than all of the disclosed costs of mutual funds. So you can just imagine what a tremendous drag on returns this is going to have. These hidden costs, they occur because we are commingled investors. So the mutual fund owns the stocks on behalf of you and me and of all the other investors in the mutual fund. And so let's say you and I buy a mutual fund today, and then we may, let's say, just invest and rest. Well, the mutual fund, of course, is going to continue accommodating investors coming in and investors wishing to redeem or divest. As the mutual fund continues to make these trades, of course, the mutual fund has to pay brokerage costs. And because you and I are also part owners of the mutual fund, that means we're paying for brokerage costs for trades that are not even occurring on our behalf. And this is part of those hidden costs. There's two other components to the hidden costs, which are a little bit more difficult to explain, but it involves something called bid-ask spread slippage and also price impact. And you can learn more about these other components of these hidden costs when you read my book.
And the book is called Mutual Funds Exposed. And for the first 10 callers, not only will we give you a free copy of Dr. Kim and Dr. Nelson's book, but we'll also offer you a mutual fund stress test in our office free of charge. The number to call is 791-5773. That's 791-5773. Of course, the area code is 225. And when you call, just say, I'd like a copy of the book, Mutual Funds Exposed, and I'd like an appointment for my mutual fund stress test. Dr. Kim, you write in the book that mutual funds can actually be over-diversified. I think some people would read that and say, what do you mean? I buy a mutual fund for diversification, but you're saying you can actually become over-diversified in mutual funds?
That's correct. And so, first of all, I think we all have to realize that there are times when there's an unnecessary level of safety. I mean, for example, if you and I didn't want to catch a cold, we could just live in a bubble, and that would assure us that we would not catch a cold.
It's no fun.
But of course, we don't want to live in a bubble. That's just an excessive level of safety. The same thing can happen with mutual funds. Mutual funds can be over-diversified because you don't need to own, hundreds of securities to achieve the benefits of diversification. Academic research has shown that, anywhere between 30 and 70 securities is enough to achieve the full benefits of diversification. But because of various distorted incentives and the way the industry is structured, and and because of other reasons, mutual funds might actually end up owning hundreds of securities, and that's not beneficial for the investor. When they own hundreds of securities, this could bring the performance of the mutual fund down, because at the end of the day, when you think about these mutual fund managers, do they really think that all 300 of their securities are going to do well? Probably not. They probably have a favorite 100 or a favorite 70 stocks. That's enough to be fully diversified. And if they only had their favorite 70 stocks, then there might be some outperformance. But because they own so many stocks, this is probably one of the main reasons why mutual funds underperform benchmarks.
The book is called Mutual Funds Exposed, and one of the book's co-authors, Dr. Kenneth Kim, Chief Financial Strategist with Equus Investments, joins us now. Dr. Kim, you've done the math. You didn't just pull numbers out of the blue sky. You and Dr. Nelson have done tons of research, and in the book, you flat out show that mutual funds have underperformed. Expound on that, please.
Yeah, it's really surprising that mutual funds are famous for their underperformance, because you would think just based on random chance, their average performance would be equivalent to a benchmark. But it's interesting that most of them have underperformed. And why is this the case? I think one of the major reasons is the over-diversification that we talked about. This over-diversification is because, look, some of these mutual funds are so large that, let's say they receive another $50,000. The mutual fund is going to say, well, we can't buy our favorite securities. We can't buy, let's say, Apple or Google stocks, because we already own too many shares of those stocks. And legally, they're not allowed to become large shareholders of any one single company. And so they're going to say, what should we do with this $50,000? Well, let's see if we can find, a filler stock. And so they're going to put this $50,000 and park it into a filler stock. Eventually, they're going to own hundreds of stocks. And most of these stocks are not their favorites, and this leads to this underperformance. And that's one of the main problems with regard to over-diversification.
Don't want to ever pretend that people are always with us and know exactly what we're talking about, right? So what's the goal of a mutual fund, right? It's to beat the index, correct?
Well, I don't know if the goal of the mutual fund is to necessarily beat an index, but that is what we're all hoping for, of course.
Right.
But what we really want is, for them to perform at least as well as an index while minimizing the return, while minimizing risk, and that's what we're trying to do. I don't want to get too technical, but there are two kinds of risks. One that can be diversified away by a professional, and one that cannot be diversified away. And when we invest in a mutual fund, we're hoping that this money manager has used his or her expertise to drive down that part of risk that can be diversified away. But I don't mean to get too technical, but that's the idea behind investing in a mutual fund, to try to get the benefits of diversification while still trying to get benchmark returns.
Dr. Kim, we're going to talk more detail in a moment and give some alternatives to mutual funds that most people don't even know those alternatives exist. But when you look at the front cover of your book, Mutual Funds Exposed, what is the number one flaw in mutual funds that after all these years and all your research and all of your education, what's the one big flaw?
There are so many. I don't know if there's a one big flaw. I mean, I think the embedded capital gains problem is a major flaw that I'm just surprised it has not been improved upon. I think the hidden costs are also a major flaw because we cannot directly own the securities when we buy a mutual fund. I think other flaws include non-transparency. According to regulations, we don't even know what we own except for 4 times out of the year. So if you ask the mutual fund manager what stocks are in our fund, he or she is not going to tell you except for 4 times out of the year. Their underperformance is also a problem, and even their sneaky behavior is a problem. As you can imagine, this is a multi-trillion-dollar industry, and they're all competing to get our business.
Dr. Kim, I've got to take a quick break right here. Can you hold on, because I want to come back and talk about mutual funds being sneaky? Can you hold on for that?
Of course.
Okay. Again, the guest is Dr. Kenneth Kim, Chief Financial Strategist with Equus. The book is called Mutual Funds Exposed. Would you like a copy? For the first 10 callers, we're offering you the book. You simply need to come into our office and let us run a mutual fund stress test for you and give you a copy of the book. The number to call is 225-791-5773. It's 225-791-5773. 791-5773. Not only for the first 5 callers are we offering the Mutual Funds Exposed book, but when you call and set an appointment with Gia, or if you are calling on Sunday, leave a voicemail. We'll call you back Monday. We're also going to offer you, as part of our initial consultation, we're going to offer a mutual fund stress test to see how your present mutual fund portfolio would stand up against certain market and world conditions. So again, for your free consultation, including a copy of the book and the mutual fund stress test, call us at 791-5773. This is Your Money Matters, presented by the Presley Group. Our guest this morning is Dr. Kenneth Kim, co-author of the bestseller Mutual Funds Exposed. Dr. Kim, in the book, Chapter 7, you have a snake slithering across the page right there. And you write, mutual funds can be sneaky. I'll just read the opening paragraph. You write, and Dr. Nelson writes, there are many mutual funds out there, and they are competing to get your money. So maybe it should come as no surprise. They may engage in some questionable behavior to get your business. You might be thinking that maybe they're just pushing the limits to get some extra profit for you, the consumer. You say, no, most of the questionable behavior is about tricking the buyer of the mutual fund. Please expound.
Oh, yeah, sure, of course, I'd be happy to. So, as we wrote in the book, it's, mutual fund industry is a multi-trillion-dollar industry, and so they are going to compete to get your business. And unfortunately, part of what they're going to do is engage in sneaky behavior, and there's a variety of things that they do. Let me just give a few examples. One is called window dressing. Because mutual funds only report their holdings 4 times a year, what they might do is, before they're reporting, any stocks that they held that didn't do well, they might get rid of those. And any stocks that did well, that they did not own, they might purchase those to make it look like, when they do their quarterly reporting, to make it look like they've been good stock pickers all along. And this is window dressing. This is done to trick us.
Wow.
They'll do other things like incubation. Incubation is where they claim that they're going to test a mutual fund performance before they make it available to investors. Now, in theory, this is a great idea. We want pharmaceutical companies, of course, to test drugs before they sell them to us, right? So this is what mutual funds claim. They claim that they're going to use their own money and they're going to test these funds before they sell them to us. Well, it turns out what a mutual fund does is they create a bunch of randomly collected portfolios, and they'll just see which ones luckily outperform. Whichever ones luckily outperform by random chance, they're going to sell those portfolios, and they're going to brag about its past performance during incubation. But what the investor doesn't know is that the outperformance that occurred during incubation was based on random chance. Because, when you create 10 random portfolios, of course 1 or 2 are going to randomly outperform. And so they mislead us into thinking that this mutual fund was tested, it's an outperformer, when really it was a random outperformer. And academic has confirmed that this practice does exist.
Wow.
And by the way, you might think, well, even if I buy a fund that randomly outperforms, then maybe it will continue to outperform. Well, these firms actually suffer losses after investors buy them. And the reason why they suffer losses is because their outperformance in the first place was random. So there's a mean reversion that occurs after we buy these incubated mutual funds.
The book, Mutual Funds Exposed, Dr. Kenneth Kim, co-author, is our guest. You also write in the sneaky chapter that you may end up with a mutual fund manager who has excessive risk-taking as the quarter comes to an end. Now, why would they do that?
You know what that is? that's leaning for the tape is something that is what we call it in the industry. And so it's just like, in a 100 or a 1 meter yard dash, you'll see that racers, at the finish line will stick their necks out because they just want, as much of an advantage as possible. And mutual funds will do the same thing. So as I mentioned earlier, because mutual funds only report 4 times a year, as their quarterly reporting, comes near, what some mutual funds might do is they might quickly, pick up a bunch of really risky stocks to see if they can get just a little bit more outperformance at the end. Now, of course, because they're taking this excessive risk, near the quarter end, most of the time their gamble is not going to pay off, and they don't really care because they had almost nothing to lose to begin with because they just wanted to see if they can get a little bit of extra. Now, you and I as investors, we don't like this kind of behavior because we're not in it for the short term, we're in it for the long term. And so when these mutual fund managers keep taking these risks, and most of the time their risks don't pay off, then we're just going to suffer additional underperformance in the long run.
I know what you're asking. Okay, Matt, that sounds fine. Dr. Kim's busy beating up mutual funds. What's the alternative? I promise we'll get to that in just a few moments. Before we move on to the alternative that you prefer, 2 more things you have to watch out for, and I think they're both worth talking about. Favoritism toward institutional clients inside of a mutual fund and helping their investment banking business. Let's start with number 1. When you write that mutual funds have a flaw in that they might be tempted to have favoritism toward institutional clients, what is that?
Well, so mutual funds might have, they don't just have individuals like you and me as investors. They could also have, institutional investors as well. And so as you can imagine, if a mutual fund has an institutional client, they're going to cater very well to that client. And when they're catering to that client, then who gets neglected? It might be just the individuals like you and myself. And so you might have a mutual fund where, if you and I are able to invest in it, it could be the case that, they just don't have institutional clients. But the ones where they do have institutional clients, you and I might not even be able to access those funds because those mutual funds want to cater to their clients. So what I'm saying here is that mutual funds, may neglect us in favor of their institutional clientele. The second thing that you raise is with regard to if a mutual fund is affiliated with an investment bank. Now, it turns out that if an investment bank, let's say, brings an IPO or a seasoned equity offering to the marketplace, and let's say it gets undersubscribed, which just means that, they try to bring an IPO to the marketplace, but there are not a lot of investors that are interested in it. Now, this investment bank now has all of these IPO shares. They don't know what to do with it.
Ooh.
They don't want to eat it for themselves.
Uh-huh.
They may ask their colleague who works in the mutual fund department, hey, can you buy these IPOs that I just couldn't sell? And the mutual fund manager will say, well, sure, since we work at the same firm, I'd be happy to help you out. Now, do you see what happens here? What happens here is that the investor, is now being invested in a mutual fund who purchased IPOs, not because they were good investments, but just simply purchased IPOs to help their investment banking division of that firm.
Dr. Kenneth Kim, co-author of Mutual Funds Exposed, our special guest this morning. So often there's the thought out there that, there's one way to do things. I'm reminded of the great high jumper Dick Fosbury, who went over the high jump bar backwards in the Olympics back in the 60s. No one had ever done that. People always straddled legs first over the bar. This guy went over backwards, and it was revolutionary. And now that's the only way people high jump. One day we're going to look back and say mutual funds, that's how we did it in the past. To learn more, be one of the first 5 callers right now at 791-5773. We'll give you a copy of Dr. Kim's book, Mutual Funds Exposed, and in addition, we'll offer you a mutual fund stress test as part of our initial consultation. So you'll get the book and the mutual fund stress test to look at how your present portfolio stacks up against certain market and world conditions. Again, the number to call is 791-5773. 5773. Area code 225-791-5773. Okay, so if not mutual funds, what's the answer? Dr. Kim reveals that next. We'll be right back. This is Your Money Matters, presented by the Presley Group. Welcome back. It's Your Money Matters. We'll get you right back to our interview with Dr. Kenneth Kim, author of Mutual Funds Exposed, and he's going to reveal a great alternative to mutual funds in a moment. Hey, today's show is brought to you by our good friends at Plantation Car Wash. They're at 1615 South Range Avenue. It's getting to be that time of the year. It's love bug time. They'll be here before you know it. First good cool front, and they'll be stuck to the front of your car. Well, at Plantation Car Wash, they've got an unlimited car wash special. You pay one price. It starts at $19.95 a month for a basic wash, but you pay one price, and you can bring your car by there as often as you'd like to. Plantation Car Wash, 1615 South Range Avenue, a small business just like the Presley Group and a proud member of the Livingston Parish community. Our guest this morning is Dr. Kenneth Kim, co-author of the bestseller Mutual Funds Exposed. If you'd like a copy of this book, not only are we offering you a copy of the book, we're also offering you a free mutual fund stress test. We take your mutual fund portfolio and we stress test it. The computer spits out a number of different scenarios, international events, world events, market events, and we'll see how your portfolio, as it presently stands, would hold up under certain hypothetical conditions. So, to get a copy of the book and schedule an appointment for a mutual fund stress test, you simply call us, 791-5773. It's area code 225-791-5773. If you get the machine at the office, leave a message and we'll call you back first thing next week and get you squared away with both the book and the mutual fund stress test appointment. Okay, let's get back into it. Dr. Kenneth Kim is our special guest. We've talked a lot, Dr. Kim, about the problems with mutual funds, the inefficiencies, the hidden costs, the tax inefficiencies, etc. Let's talk about a solution. And that solution, you say, is 3 simple letters.
Yeah, so the 3 letters are SMA, and that stands for Separately Managed Accounts. Because, at the end of the day, what do we want to do for all investors? And what do all investors really want? What they want is to have a professional to work directly for them and to select securities and to put together a diversified portfolio where we can directly own the securities. And this is called a separately managed account. I mean, this is the way that the ultra-rich invest. I'm sure Donald Trump and Mitt Romney and Mark Cuban and Oprah Winfrey, I'm sure they don't buy mutual funds. I don't think they're talking about, should I buy a Fidelity fund or a Vanguard fund? What they do is, because they're so wealthy, they have professionals managing money for them and putting together portfolios for them. This is also the way that institutional investors invest. This is also the way that Harvard, Princeton, Yale, and other universities invest. Okay, and so what is the separately managed account? Is having a professional select securities on your behalf, and you can own these securities directly. Now, this investment option has always been around. It's been around for a long time. The reason why people like myself could not invest in this before is because to have access to this kind of professionally managed account, you would need to have an account minimum of $1 or $2 or even $5 million. And so this was, And so this is an investment that only the super wealthy could afford. But with technology that's available today, this way of investing is now finally available to just ordinary investors like myself. For example, at my firm at Equus Capital, you can be in a separately managed account for as little as $25,000 account. So if you have $25,000 to invest, you can be in a separately managed account where your money, your $25,000, can be managed by a professional, and you will directly own these securities. So then that means you're not going to suffer the embedded capital gains problem, the tax inefficiencies that we talked about. You're not going to suffer from hidden costs because there's no commingled investor. You directly own these securities. This issue of transparency is a non-issue because when you directly own these securities, you will know 24/7 exactly what it is that you own. And so this is what's nice about it, having a separately managed account. And by the way, with the way Equus does it, my firm, not only does this $25,000, is it going to be professionally managed by a professional money manager. If you want, you can have that $25,000 managed by 10 or 20 different professional money managers.
Mm-hmm.
So in essence, you can actually outdo the ultra wealthy and have a dozen money managers manage your $25,000 account. How is this possible? It's possible because of technology.
So for a minimum balance of $25,000, someone can, like you said, thanks to technology, have access to multiple money managers. And unlike a mutual fund, I believe I'm right about this, it's not necessarily just a passive investment that sits there and floats along like a boat riding the roller coaster on the water. These money managers in many of these SMAs, these money managers are actively watching the account and doing what a money manager should do, and that is helping you when the market's down, helping you when the market's up, right?
That is correct. And so we have a variety of money managers that's available on the Equus Capital platform. And so that's another nice feature of what's available today with technology. If you have, let's say you decide that you want to have your $25,000 or more managed by, let's say, 12 different money managers. Some of these money managers might be passive, and you might decide that you want some money managers that are also very active. The active money managers, we call them tactical money managers. And so these money managers will be very active with regard to their investing style and their portfolio allocation, with regard to when they decide to go to cash, with regard to when they decide to change sectors. And so that's the nice thing about technology that's available. You don't have to be with only one style of investing. You can have your money invested across different types of styles, which is very nice. And so this can be accomplished because of the multiple money managers that you can have access to.
Again, the book, Mutual Funds Exposed. And for the first 10 callers right now, or if you're listening on a Sunday, call and leave a voicemail. We'll call you back first thing Monday. But the book is Mutual Funds Exposed. It's an easy read. I've got to brag on you, Dr. Kim. You and Dr. Nelson did not go overboard and get super technical. The book, it can be read in a few hours. I urge you to get it and read it a few times. But for the first 10 callers who call in, we'll set you up with the book and a mutual fund stress test. You'll have to come to our office, bring your statements. Let's compare your present portfolio to the current SMAs that are out there now and see how it would perform in a mutual fund stress test. So the first 10 callers can take advantage of that now at 791-5773. Again, it's area code 225-791-5773. Dr. Kim, before we let you go, and thank you for the time on the book, I can't help but probe your brain about this stock market. It's been up and it's been down. Now, full disclosure, I'm on your alert list, and so Christy and I are able to find out what's on your brain. I know that you think there's too much nervousness over China, right? You don't think China is in as bad a shape as maybe the mainstream media is making out.
The mainstream media is fixated on what's going on in the Chinese stock markets. I lived in China for 4 years. I was a professor at Renmin University in Beijing, and I was also a frequent commentator on China's only English-speaking national TV station. So I kept up on Chinese economic policies and their capital markets, and I can tell you this fixation on the Chinese stock markets is highly misplaced. China, the Shanghai Composite Index a year ago today was at around 2,200. It went to over 5,000 within a year.
Wow.
And so there was obviously a bubble. This bubble occurred because there was a bit of irrational exuberance surrounding the fact that they were soon going to start allowing IPOs again because they put a halt on IPOs for a while. So there was this irrational exuberance, and the market almost tripled in value. And so when you have this kind of, huge surge in valuation, it's obviously a bubble. And of course, bubbles have to burst. And this bubble did burst. The Shanghai Composite Index is still at 3,000. The Chinese markets are still way up over the year. It's just simply the fact that there's just been a bubble burst, and that's it. There is no problem with China's real economy. I mean, China is very conservative with regard to their growth. They're going for stable growth, not just growth for the sake of growth. Their monetary fiscal policies are sound. They recently devalued their currency to continue to make their exporting competitive. Everything is going along smoothly in China, especially with regard to the economy. People should not focus on what's going on in their stock markets as a barometer of what's going on in the Chinese economy.
Okay, how about here at home? How about the U.S. economy? I hear Jim Cramer on CNBC. He's very concerned about corporate profits, et cetera, et cetera. Are we healthy?
We are healthy. Because if you think about what is wrong with our current economy, there's very little wrong with it. And so people always say, is the next 2008 around the corner? 2008 was not a correction. 2008, what happened in 2008 was there was a problem in the real economy in 2008 because, as you know, people that did not deserve to get mortgages were getting mortgages.
Yep.
And then they eventually started to default, which meant that the mortgage-backed securities started to collapse, and all the financial institutions that were overexposed in those securities, went down and brought the economy down with them, the global economy down with them. So that's where there's a huge flaw in the real economy. We don't have any flaws in the real economy right now. Interest rates are low, inflation is low, unemployment is great. And so when you look at the macroeconomic indicators, we have a healthy economy. And so if we experience any kind of sort of correction, it's something that I really don't anticipate because I don't think that we are in a bubbly situation right now. Of course, if the Fed decides to hike interest rates, later, around the corner, that's going to bring the valuations down. But other than that, I don't see any reason why we should fear a market downturn that's going to last for a long period of time.
So are you then saying, Dr. Kim, that the recent pullback from the highs of the Dow just over 18,000 back to our mid-16s, is that just a healthy, necessary pullback?
I think we're gonna bounce back from this. Right now, there's uncertainty. The people are uncertain about China. People are uncertain about oil. People are uncertain about what the Fed is going to do. And so because of these three things, whenever there's uncertainty, the market values are always going to go down until they sort it out. But once they sort it out, they're going to realize a few things. One, there's really nothing wrong with the Chinese economy. Two, when oil prices go down, it's really only the energy sector that will suffer. All the other most other sectors actually benefit from low oil prices. And three, if the Fed does decide to raise interest rates, we've been anticipating this for so long that we've almost kind of priced that into our current valuations. They're going to raise interest rates either in September or December. We don't know, but it's inevitable that they're going to because, and again, the reason why is because they may feel like the economy is now healthy enough to withstand it. And so I think when the market sorts all of this out, I think this current valuation that we're in the mid 1600s, that's just going to go back to the 1800s very soon. This is something where we're going to recover very quickly. It's not going to be something that gets dragged out like we had in 2008.
The book is Mutual Funds Exposed. Our thanks to author Dr. Kenneth Kim. If you'd like your copy of the book and a mutual fund stress test, it's simple. Be one of the first 5 callers at 791-5773. That's 791-5773. We'll set you up with a 1-hour, no-obligation appointment, give you a copy of the book, and put your mutual funds that you have now through the ringer and see how they stand up with the mutual fund stress test. 791-5773. This is Your Money Matters, presented by the Presley Group. Matt Kennedy and Christy Smith, Your Money Matters. Christy, unprecedented market volatility. August was the most volatile month on Wall Street in 17 years. Think back 17 years ago. Were you still in grade school 17 years ago?
No comment.
But 17 years ago, September 1st was the worst September 1st in, I think, 15 years. So we're seeing ups and downs. The market plunges and it roars back. It's enough to give you a heart attack, right?
It really is. And while Dr. Kim stresses the importance of evaluating your investment portfolio, maybe you've got some mutual funds that you need to look at. You know, one of the things that we use in our everyday practice is safe strategies using fixed index annuities to help build solid retirement plans. And when we talk about a retirement plan, we really talk about a lot of things that work together. You know, it's kind of like building a house. You have that solid foundation, and then you have the slab, and then you have the frame that goes up, and then they put the roof on top. And that's really how a retirement plan should work. Mm-hmm. And so right now, it might be concerning to you to look into your 401k account and see the value has gone down, or maybe you're looking at an IRA or your investment portfolio and the value has gone down. While many people believe the market's going to go back up, and it may, now is the right time for you to consider what your options are as far as building a true retirement plan.
Remember, it wasn't that long ago we talked about emotions and how emotions can make you a poor investor because you get scared. I was talking to a couple earlier this week, and his wife has a 403B from a previous job, and they left it behind, and we've been talking about positioning it into safety, and they have not yet made a decision. And he said, wow, we took a hit over the last couple of weeks. He said, so we moved it all to the guaranteed fund.
But see, that's what happens, Matt.
It's exactly what happens. But if you go to the guaranteed fund earning 1%, how long is it going to take them to earn back the money that they've quote-unquote lost?
And that's what we've heard over and over again from different economists like Mark Holbert. They stress the fact that we as individual investors don't time the market right because we let our emotions come into play. If I take a call last week, somebody saying, what do you think about the markets? I'm going to say, well, I don't have a crystal ball. I don't know what's going to happen in the market. But what I do know is we can create a solid plan that's designed for your future. It's not it's not a get rich quick. It's not buy in today, get out tomorrow. These are long-term plans. Now, Dr. Kim is talking about separately managed accounts and the value of that. One of the things that we have been able to do is partner with a company called Equus Capital out of California. We're an investment advisor representative through Equus Capital Management. The thing is that with a separately managed account, we have new ways of investing, ways that we've never had in the past because they were only available to the very wealthy. Yet Equus has brought it down to a platform that we're able to use with as little as $25,000. So we've got a lot going on at the Presley Group, a lot of ways that we can help you build a solid retirement plan. We need you to pick up the phone, call us, and schedule your complimentary visit. Remember, when you schedule that visit, you're going to get a free book, Mutual Fund Exposed. Of course, if you have mutual funds. If you don't, you may not want it. But if you want to learn about mutual funds, we'll be glad to give you that book. But we're also going to build you a 5-point retirement master plan. And when you think about our 5-point retirement master plan, I want you to think about the things that you're going to get in that plan. The first thing we're going to give you is a Social Security optimizer. This tool is going to help you determine what's the very best way to get the most out of your Social Security benefits.
Earlier this week, had a chance to meet with some people at a Social Security optimizer workshop. We had about 15 people there. And a gentleman walked up to me afterwards and he said, Matt, thanks so much. He said, I'm pretty savvy about investments. I've got a lot of investments in real estate, et cetera, et cetera. He says, but I'm 61 years of age and I don't have the foggiest clue about the right way to claim Social Security. There are 567 different ways that a married couple can file. It can be overwhelming, but the Social Security Optimizer simplifies it and helps you understand how to squeeze every single nickel out of Social Security. That's just one part of the 5-point retirement master plan.
Now, in this plan, you're going to also receive a sure bet strategy on how to receive retirement income, lifetime income. These plans are safe. They're designed to grow until you retire and need an income. Did you know many of you can use an in-service distribution and take money out of your 401k and position it into your own IRA right now? It gives you better control of your money. So we'll give you that report in the 5-point retirement master plan.
One of the beauties of an in-service distribution, I don't want to rush over that. Listen carefully. If you're 59 and a half or older, some of you, not all, Christy, most people who are 59 and a half or older, the IRS says your company has to let you take money out of your, maybe it's 403B or 401K, and you're allowed to move that money into your own IRA. Why would you do that? Because when situations like what's transpiring now, and we're seeing this 10+% correction happen, you can have your money positioned in something that you know is not going to go away when the market tanks. It's there to provide you income. It's got safety, and it's got a contract wrapped around it so that you know you don't have to get emotionally involved and quickly sell because the market's going down. That builds your foundation. After that, then we talk about building some walls. But you need a foundation, and that's what the 5-point retirement master plan does.
Now, the next thing we're going to give you in the 5-point retirement master plan is we're going to give you a report that shows you, well, why most typical retirement plans don't work. You know, most people have a lot of mutual funds built into their portfolio. So we're going to run a mutual fund stress test for you and see if you're properly positioned.
Our phone number is 791-5773. Give us a call if you get the machine, leave a message. We'll get back with you and take care of your mutual fund exposed book and your 5-point retirement master plan. No cost, no obligation. 791-5773.
The topics discussed on this show are developed from sources believed to be reliable and is provided for informational purposes only. Chrissy Smith and Matt Kennedy are investment advisor representatives with Equus Capital Management, Inc., a registered investment advisor. Neither Equus nor the Presley Group render or offer to render investment advice through this program. This is not an offer to sell securities or provide investment advice, which may be done only after a client suitability review is conducted and appropriate disclosures made. Advisory services are offered through Equus Capital Management, Inc. and may only be offered in states where registered. Equus does not provide insurance services. Neither the Presley Group nor Equus provide tax or legal advice. The Presley Group, LLC, and Equus Capital Management, Inc. are not affiliated.